Hello, so in this video I want to teach about equilibrium trading in the Forex market. It's a concept that is hardly covered. It's not easy to come across lessons on equilibrium, but it's very important to understand it, especially if you want to know deep price action concepts. So when we talk of equilibrium trading, most people already know when trading a trending market. You've been taught probably that you need to draw a Fibonacci from one point to the other, and you've been advised to look for an entry anywhere from the 50% level, right? But most people don't have the understanding on why you need to look at that level or why that level is that important. What is special about the 50% level that price comes here and it bounces off and continues buying? So all that is part of the equilibrium concept. Also, looking at any forex market, you'll be able to realize that the structure of a forex market is not consistent in terms of price direction. What that means is that from this point here, let me just mark it from this point here, A, to this point B, you see price bought, but price didn't buy in a straight manner. We had a lot of ups and downs. If you're able to mark, price was buying, dropping, buying, dropping. So we had a lot of confusion before price was able to get to that point. So the reason why this happens is because of this equilibrium concept, which I now want to explain in this video. So you can see this is how price bought. So price moves from this point here, which we'll call A, to the point B, but it doesn't move in a straight manner. It moves in a sequence of ups and downs. So it's easy for traders to know that price could go a certain direction, but because of these games, most traders lose money because you cannot find a good entry point. So you are right on the direction, but it was hard for you to get an entry point. So let me explain the equilibrium concept so that you can understand how it comes to affect trading and how you can use it for your benefit. So if I just return to the charts, you realize one thing. Every other time that price buys, it must sell. If you just try to monitor, you will see after price sold to this point, it's bought, it sold, it bought. So why is it that price must keep on buying and selling at each point? Why can't price just drop for a while or buy for a while and then it shall sell later? Why is it that we must have all these ups and downs in the forex market? In any market, we must have two opposing forces. And in the forex market, it's a similar case. The two opposing forces here are the buyers and the sellers. They're opposing each other because as buyers are trying to push price higher, as you can see with the green arrow, sellers here are trying to push price lower. So when price buys at some point, sellers also come and push the price lower. So let me explain why this happens. Most of the time, it's because the market is always trying to seek equilibrium. Let's start by seeing a market that lacks equilibrium so that we can understand why the equilibrium concept is very necessary in the forex market. When we have demand in the market, they'll tend to be stronger buyers than sellers. On the other hand, when we have supply, they'll tend to be more strong sellers than buyers. So from at this point where price is pushing to the upside, it's easy to say that we have a strong demand. When it's pushing to the downside, we have supply. So let's look at a market where price was pushing to the upside without any retracement, because in a normal market, we are expecting to see price make such moves. But let's look at a market where price just goes to one direction without forming any retracement. So in this market, price is simply buying alone and it's not selling at all. So that means each candlestick, this is just an assumption, that means each candlestick is bullish. So that means we only have demand and we lack supply because we have no sellers in this market. So first of all, this market is very imbalanced. So when you have imbalance in the market, it means one side is stronger than the other or one side has overpowered the other. So if we had such a market where we only had buyers and no sellers or the vice versa, it simply means that this market will be impossible to trade because first of all, it will be a waste of time because there will be no liquidation in this market. This market will be very illiquid because you see in a normal market like this where we have buyers and sellers, you must realize that at any particular point, while one is buying, there is someone somewhere who is selling. So what that means is that There's someone who will make money and there's one who will lose money. So the fact that we have money to be lost, it means that it's easy to liquidate your positions into cash. Because in this market where we only have demand, everyone is buying, but there is no one who is doing the opposite. So there is no opposing force. So that means there's no money to be made in such a market. So that's why whenever you see price pushing to the upside for a long time, it is inevitable that at a certain point in time, sellers must come and try to push price lower. Either they'll make a complete reversal or they'll just push the price lower at least to the equilibrium. Then again, you'll see price shooting to the upside in such a move. This is because this movement of ups and downs creates equilibrium in the market. Now, the fact that we have this retracement, it means we now have sellers. So we had the buyers and we now have the sellers. And to make this clear, if you use a commodities market, maybe it will be simpler if I use this example. Assume a market where we had buyers but we had no sellers. So that means we have people who are simply trying to buy things. So there is demand, but there is no supply. So you see that market cannot exist in the first place. Same thing if we had people supplying goods and services, but we had no people buying the goods and services. So you have supply, but we have no demand. And also, if we have more suppliers than the people who are demanding, we have an imbalance in the market. So we have surplus, right? So it's just the same concept in the Forex market. That's why when price is buying for a long time, that means we have strong demand for a long time. It has to start selling again at a certain point in time so that it can correct that imbalance. Because if it buys forever, we'll have an imbalance. Or if it buys for a long time, without making any retracement, we will have a price imbalance. So that's why we must have the movement of buyers and sellers moving up and down. So in other words, the reason why a forex market looks like this is because price at any particular point usually sticks to price seeks equilibrium. So when price moves from this point, let's call it A to B, that was strong buyers in the market. It could have continued buying immediately, but it starts selling because price is seeking equilibrium. You see, that's why it's very possible to find. Let me just show you something. It's possible to find a trending market, and this is something that most of us have learned about and know how to trade. These are trending markets, right? This is a market that is in an uptrend. We're having higher highs and higher lows. So this price moved from this point, let's call it A, to the final point above here, we can call it B. But it didn't move in a straight manner because as much as it was easy, let's say you even knew that price was going to buy, you knew price was going to buy from this point to that point. You see, if you took your position there, price didn't buy that smoothly. It must keep on making these retracements. So these retracements, it's because the market is seeking equilibrium. So this market seeking equilibrium is because price wants to come to balance before it can continue going up. So the buyers have pushed price up, but the sellers must also try and push price lower to a certain point before the buyers can continue being in control. So this move, which is a retracement, sometimes it's called a correction. The reason why it's called a correction is because these sellers are simply correcting the imbalance that was happening when price was buying from this point to that point. So this move is called a correction move. And also, it's not at all times that the price will always get to the equilibrium level. For example, at this point, price can buy, then it can retrace to equilibrium, which is half of this move. But there are times when price will try to seek equilibrium, it will fail. It will only make a small retracement and continue. So it's not at all times that price will always be able to achieve the equilibrium target. So let me show you how you can be able to apply this in the real chart. First application is in a trending market. So when you have a clear either uptrend or a downtrend, you want to identify the impulse move. So you see price push from this point to that point, then it starts retracing. So when we're having a retracement, since you already know it's an uptrend and that the general direction is towards the upside, when we have a retracement, you want this retracement to cover at least half of that move, because when it covers half of that move, it means price will have achieved equilibrium. So you see price comes and retraces, and it comes to the 50% level. And at the 50% level, we have equilibrium because it's now half of the previous move. So when price gets to the 50% level, you see we had a bullish structure formation and it continued buying. It doesn't mean that any other time that price bounces off the 50% level, you immediately take your trade there, but you want this retracement to come at least to this level. So what I'll advise is that in future you can, when price gets to the 50% level, you can mark anywhere between the 50 to the 78 level, and that's where you want to find your entry. There are times that price will get here and form a bullish structure. There are times that price will get here and it won't form a bullish structure. It will continue dropping to the 61% or the 78%. But the whole point is that the equilibrium has already been achieved as long as price hits the 50% level. There are times that this equilibrium won't be achieved. Price might retrace barely to even to the 38% level and continue going up. But most of the time, whenever price is retracing, you want it to achieve equilibrium first so that you can have a high probability setup. The final application is how to use the equilibrium concept to get a sniper entry in the forex market. But let me just build up by first explaining a concept to you. In a trending market, whenever, note that I'm saying in a trending market, so it must be a trending market in the first place. In a trending market, for instance, here where we have an uptrend with higher highs and higher lows, when you see these long body candlesticks, these long candlesticks, they indicate momentum. So I want you to realize something significant that will happen over time. You see, on this long candlestick, price will come and retrace to this body of this long candlestick. It will either retrace to half of this candlestick, or if it goes below, it won't be able to break this candlestick. That will happen most of the time. I want you to realize that. Let's just put a straight line. You can see price bought, it started retracing, it retraced, but it was unable to break below the body of this long candlestick because the direction is an uptrend and this candlestick is showing momentum. So this correction is just simply the market trying to seek equilibrium. So the fact that we had this very long candlestick is a sign of imbalance, you see. So price will come and retrace to the body of this candlestick just to try and seek equilibrium in the market. So after the equilibrium has been achieved, what happens next is that price continues going up. Let's also look at this long body candlestick at this point. We can even go further and draw a Fibonacci on this specific candlestick to see its equilibrium. So we'll draw a Fibonacci from using the body, not the shadow, the body of the candlestick. I want you to see, then mark the 50% level on that long body candlestick. There is a chance that price will bounce off that 50% level. As long as you are in the direction of the trend, this doesn't happen all the time, as long as you're in the direction of the trend. So you can see that's the 50% level of this long body candlestick here. Price comes and retraces to the 50% level, and then it bounces off exactly. Same thing to here, we have a long body candlestick. Price was buying, then it starts to retrace in attempt to seek equilibrium in the market. Let's see whether price is able to close below that long body candlestick. It's also unable. Same thing, price retraces to this long body candlestick, but it's unable to close below. This is a shadow, meaning we have rejection. In fact, it rejects it and we have a spinning top and an engulfing, then it continues to shoot further up. So that being said, let me now show you how you get a sniper entry using this equilibrium concept. So the sniper entry that we are going to get is going to be using this candlestick. You see this shadow here. We want to get a sell trade there. I just want to show you first the trade so that we can do the analysis. We want to get a short position at this point and a very tight stop loss because it's a sniper entry. And the risk reward here was very good. You see, you got over 90 something pips. So we want to get our trade at this particular point. So let's see how you're able to get your trade there. First of all, before you get your trade, for you to get a sniper entry using the equilibrium concept, you must know the direction of the trend. You must know the market structure and know the general direction of the market. So first of all, since it's a sell trade, we want to confirm that the market is in a downtrend. And indeed, you can confirm that price is forming lower highs and lower lows, showing that it's in a downtrend. Second thing, we want to do a normal analysis. So price dropped from this point to that point. Let me mark using the arrow. Price dropped from that point to this point. Then we now have a retracement. So when price is retracing, we want price to at least achieve equilibrium. That's the first thing. So we want to drop our fib retracement from that high to the next low. Then remember what I told you, mark the zone between, because I told you there are times that price will get to the 50% level and it will continue further until it gets somewhere to this 78%. So I told you mark the zone between the 50 to the 78. So what you want is price to form a bearish pattern between the zone 50 to 78. So number one, we've identified the trend. Number two, we've spotted that price has dropped and we are now in a retracement. So since it's retracing, we want to use a Fibonacci retracement and mark the zone between 50 to 78. So we are expecting to get a continuation of the downtrend here. So we want to look to see if we'll get any valid pattern at this point. And what happened is that price actually formed something like an M pattern. If you look clearly, we have a double top. Let me mark with a straight line. We have a double top at this point. You see, this is the first top, this is the second top. So we have a double top. So we have an M pattern that forms, confirming to us that price is forming now a bearish structure. So at this point, it's not safe to take the sell trade yet because price could easily start buying again and continue buying a little bit further before it starts to drop, or it could even completely reverse the structure. But since we are trying to follow the high probability direction, we have our first confirmation at this point, so we won't take our trade, we'll wait for another confirmation. What happens is that we had a little bit of something like a consolidation here where price was playing around here. Then after the consolidation, we got a price breakout. So after getting this breakout, this is now confirmation enough that we can now get into a sell trend, because this breakout has also happened and this price has closed below this neckline, right? So when price closes below that neckline, it's a good sign that this candlestick here is the breakout candlestick. Let me just mark it. This is the breakout candlestick. So the breakout candlestick is the one that we want to use to get our entry. After the breakout, we want to get our entry. So after getting this breakout, getting your entry is very simple. Though there are times that this might not happen, but most of the time you want to draw a Fibonacci on this long candlestick. This is the breakout candlestick. So you come and draw a Fibonacci. So we want price to come back to the 50% level of that Fibonacci, simply because when it comes back to the 50% level, we will have achieved market equilibrium. So we draw Fibonacci on this candlestick. This is the candlestick we are using. Then you come and mark the 50% level. Let's mark the 50% level and extend it so that you can see if price got there. See, price bounced off exactly at the 50% level, exactly at the 50% level. So if you had your sell stop at this, if you had your sell limit, a pending order at this particular point, you easily got a sell trade, and this is a sniper entry. You had zero, and I mean zero drawdown. There was no drawdown at all. So your stop loss above this body of this candlestick, that's about 14, 15 pips. Your TP will depend with your risk reward, but price dropped all the way to about 98 pips. So I want you to see how we got our sniper entry. So you might see sometimes people taking sniper entries and you wonder, how did you know that the market was going to get to this point and reverse from that point? You didn't know. It's just that you use the smart money concepts and you combine several of them through confluence trading to be able to get a setup. So understanding this equilibrium concept will help you a lot. It will save you to avoid taking bad entries, because there are certain points in the market where it's not safe to get an entry, because you'll be able to know that the price has been selling for a while. So what happens, instead of taking a sell trade here, you see here it was safe to take the trade, but you don't come and take a sell trade here, because when you understand equilibrium, you know after the price has dropped, there is a high chance that after dropping for a while, what will happen? It will first retrace before it continues dropping. So instead of taking a sell trade here, then you come and hit stop loss, yet you are right on the direction. You wait for it to retrace and achieve equilibrium again so that you can continue with your sell trade. So that's it for this video.